To you once again. And we are at the last stage of financial ratio analysis, and the last bit that we shall discuss today are called solvency ratios. Several occasions we have discussed that what exactly is meant by the word solvency. By solvency, we mean that at no stage the total assets of a company would fall short of total liabilities. So, in other words, a company is said to be solvent if its total assets are more than its total liabilities. And I hope you know that the difference between total assets and total liabilities is called the shareholders' equity. It means that the shareholders' equity must be positive. You can see here that a company is said to be solvent if total assets are more than total liabilities, so that the total equity is positive. I know we discussed it last time, but that was only in the brief. So this is called solvency. Invariably, every time a company becomes insolvent, it is because the company's total assets are falling short of total liabilities. If you just Google number of companies bankrupt in 21st century, for example, you will find a big list of corporate giants who became insolvent. And the one common criteria of judging them bankrupt or insolvent is that their assets fell short of their liabilities. Okay, it's like life. We are said to be alive. We are reckoned as alive people as long as we can breathe, we can walk. So there are certain criteria of a human being being alive. And same way, a company being alive is when its total assets more than total liabilities. In other words, its equity is positive. When equity becomes negative, it means that the shareholders have lost nothing. Their worth is nothing. So those pieces of paper which they have, they can just go and put in the nearest dustbin because they mean nothing now. There are different ways to measure solvency. And each way, they're quite similar. They're not radically different from one another. But of course, there's a little bit of difference, and there is a meaning why that difference exists. The first ratio that we discussed today is called total debt ratio. And what we do here, we have the total assets minus total equity. In other words, we talk about the total liabilities. Total liabilities divided by total assets. So it would show that how much is the liability constituting €1 of total assets. If it happens that the company's assets minus equity, in other words, the liabilities, right? If a liability divided by total assets is 0.8, it means that for every €1 that company owns, every €1 that company owns, it owes 80 cents. Usually, when the ratio is rising, many times you have seen that if the return on assets is increasing, if companies' current ratio is increasing, it's a good sign. But this ratio is a bad sign. If this ratio is increasing, it's a bad sign because it, for example, last year it was 0.75 and this year it's 0.85. It means that what company owes is slowly eating away what company is owning. Okay, so you have to be very careful that if this ratio is increasing, you need to be careful. And we don't have a legend of this company. You only have to compare the company with itself over time. And if in the last 3-4 years, this ratio is significantly increasing, then you have a very big reason to be worried of. Okay. Remember, in the financial ratios, there are some ratios, if they are not so good, not so promising, you can still live with it and you can come back later to rectify them. But if a company's total debt ratio becomes more than 1, it means that total liabilities are more than total assets, the company would cease to exist altogether. So this ratio, if it is increasing, even though it's below 1, but for the last 3-4 years, you notice that this ratio is going up and up and up, even though it's below 1, okay, you have a reason to be worried. It's a very serious threat. It can pose an existential threat to the company if this ratio is going consistently and considerably up, okay? The second ratio, which we often use in the financial ratio analysis, is debt to equity ratio. Debt, total debt, divided by the equity ratio. I would say that if I were you, actually I have done in the same way in the BP template, the debt to equity ratio, I would rather take the finance debt or the long-term debt, rather than the short-term debt. If you are a lender, you watch this ratio quite carefully. If I'm a bank and I have given a lot of debt to your company, lots of loan to your company, and I keep observing that your debt to equity ratio is increasing, my stakes would be under threat. Because if your debt to equity ratio keeps rising and rising, I would be afraid that perhaps you will not be able to pay back my money. You will not be able to pay me interest. You will not be able to pay my debt back. You won't be able to repay the loan. And as a result, if you don't pay me, then I also, because I'm also a bank, I'm also a company, I'm also an organization, I also have my own shareholders. Then I could be in trouble as well. And this is how the corporate bankruptcies start. It's like a pack of cards. When one company becomes bankrupt, it can't pay to its suppliers, it can't pay to its banks, then the suppliers company fail and the bank fail, okay? And then the bank owes to other bank and then those banks fail. So it's like a trigger point. So if you are a lender, especially the institutional lender, then you keep this ratio, you monitor this ratio very carefully and quite consistently. And that is why many times when you are borrowing from the bank is covering its risk by making you write the covenants. And we use the phrase debt covenants. The covenants are, for instance, if I'm a company and I want to borrow from Nordea, I go and let's assume that they sanction my loan. All right, I'm very happy. And now the time has come when me and the bank manager of Nordea will sit together when we sign the agreement. There'll be certain clauses, clause 1, clause 2, clause 3. One of the clause would be that if I need a fresh loan, I can't just independently go and ask Danske to give me a fresh dose of loan. Because if I borrow without the knowledge of my previous lender, which is Nordea, I'm putting Nordea at risk. Guess why? If I start doing this loan shopping from wherever, or whatever, what will happen? My debt to equity ratio will go up. And it's quite possible that I'm not able to pay back my lenders. And my original lender is Nordea. They gave me loan by looking at my project. They were very happy, but that doesn't mean that I can borrow from whosoever I wish to. They would make me sign a clause that if I need the fresh loan, I can't just go to any bank or any individual. and ask for the loan. For any future further loan, I need to inform Nordea because that's my original lender. And without their permission, I can't borrow from anybody else. And this clause, we use a word, it's a legal word called covenant, debt covenant. Covenant means it's a kind of, how to say it? It's kind of bond between me and the bank. Okay, so whenever you take a loan, the bank manager would give you a long list of those, the clauses, which sometimes you don't even look at. But one of them would be the debt covenant, which means that you can't borrow further without the permission of the original lender. Okay, and this debt generally includes the current and the non-current, but if you see the point of view of very strong Puritan, those who are very, strong believer, very traditional finance researchers, they don't like to include current debt into total debt. The idea is that the current debt is not meant for the long-term investments. The current debt is to ensure that your working capital is in a good shape. So you are able to pay for your salaries, you're able to pay for the electricity, you're able to pay tax. So all those operating expenses, which you are, you meet that. So this is the second ratio called debt to equity ratio. The third ratio is the gearing ratio, which goes beyond the debt, and it also includes the liabilities. Okay, remember that debt is a liability, but not every liability is a debt. I hope you understand this point. Yeah, do you? Sorry. Debt is a liability, but not every liability is a debt. But in this ratio, if you look, the numerator is not just restricted to debt. It is including the long-term liabilities. Yeah. How do I know that these are long-term liabilities? How do I know that the numerator is long-term liability? Yes. So that means long-term liability, right? And what is the right word? Which is the word we often see in the annual reports for the long-term liabilities? Usually, you never see the word long-term liabilities in the annual reports. What is the right word? Non-current liabilities. Yeah. These days, I don't know why the accountants have stopped using the phrase long-term or short-term. But nowadays, the more often phrases that we see are, for the short term, it's a current, and for the long term, it's non-current. Okay, don't know why. Yeah, so you know where to get it from, and just to let you know that the different words of debt could be, yeah. And then we have the equity multipliers, total assets divided by total equity. Yeah. Nothing much to say. Yeah. And the last one is total capital employed divided by the shareholders' equity. That total capital employed. How do you calculate, by the way, total capital employed? Sorry. Do you know how to calculate the total capital employed? Any ideas? How do you calculate the total capital employed? Where you get it from? Yes.
It's the sum of the total liability.
Total capital employed includes the debt and equity. But when it comes to debt, we include the non-current debt. Yeah. So it's a sum of non-current debt or finance debt, what do you call it, plus the shareholders' equity. And then you divide it by the shareholders' equity. So basically, the shareholders' equity is added to the numerator as well as in the denominator. And then some people say that we also calculate the long-term debt ratio. Well, I think you can, depending upon the need and requirement, you can pick up any of these ratios. Yeah, so this ratio is only about the long-term debt. So I don't see the reason why can't you find it. The assets, so most of the information in this set of ratio will be coming from the balance sheet. I don't see anything is coming from the income statement in this set. I don't think so. So all your input data is coming from the balance sheet. Yeah. Look, the formula is given here. Total capital employed is equal to non-current debt plus total equity. So it's quite straightforward. I forgot to mention that we still have a couple of more ratios to go about, and these are called investment ratios. The first ratio that we calculate is the earnings per share, or the EPS. The shareholders of the company, if I have to mention two most important ratios which the shareholders see, then I would say that EPS is one of them. Okay, EPS, the earnings per share, is calculated by net profit after tax, yeah, minus what you give. By the way, what is net profit after tax? Who it belongs to? When you have calculated net profit after tax, or the profit after tax, by the way, who this profit belongs to? You can call it profit after tax, or the income after tax, or earnings after tax, or just net profit. Who do this profit belongs to? The shareholders. Yeah, the shareholders. But we make a small tweak. We also reduce the preferred dividend. Do you know what is preferred dividend? Who knows it? Preferred dividend. Yes, anybody else?
Should I say something before?
Yeah.
I hope I should advise everyone, if you are in the class, please pay attention to your lecture. Most of you are doing your own work or something else, not paying attention at all. So
thanks for reminding.
I'm just giving answers. If you are in the class, please show your presence as well. Your active presence.
I think that active presence is very important, because we're not taking attendance, basically. So you may choose not to come if you are so busy in some other stuff. Yeah. Because then the problem is that after some time you will say that, oh, we haven't understood. It was too difficult. Well, it was not difficult. You didn't pay attention. Let's be fair. So the preferred dividend is the dividend. Yes, sir. Yeah. Yeah. Do you remember we have two types of shareholders? Do you know that? Remember, we have two types of financiers, debt holders and equity holders, right? But even among the equity holders, we have two categories of equity holders. One are called controlling shareholders, and the others are called non-controlling shareholders. Have you heard these phrases or not before? Have you heard the word controlling shareholders and non-controlling shareholders? Have you heard that? It's very important to know, because sometimes I'm in doubt if I even mention these. When I don't see any responses from you, I feel that I'm speaking English or I'm speaking some Spanish. So we have controlling shareholders and the non-controlling shareholders. Controlling shareholders have a quality that they control the company. How? Through their votes. They have the voting rights, but then they are not the first one who would be in the queue who would be getting the share of profits from the company? Who would be the first one in the queue to get the share of profits from the company? They are called non-controlling shareholders. You might have seen, many of you would be seeing that in the income statement, when you have the final profit, it is split between two types of shareholders: controlling shareholders and the non-controlling shareholders. The non-controlling shareholders, they have to give up their voting rights. They don't have the voting rights. But what privilege they have? The privilege they have is that when the company is going to give dividends to the shareholders, they would be first in the queue to get the profits based on their investment. You get my point? So we have non-controlling / preferred shareholders. It's one word. And what preferred shareholders they get from the company, you can also call it preferred dividend. So what stops you from saying it? On the other hand, most of your shareholders would be the controlling shareholders. Controlling means they are the one who vote, and they are the one who have the leftover profit. And what are the synonyms of the controlling shareholders? We call them common shareholders, or we also call them ordinary shareholders. Common, ordinary. Look at the word. It sounds very kind of humiliating. Common. You are a common, and he's preferred. Come on, where is democracy? Well, so the common shareholders, or the ordinary shareholders, or the controlling shareholders. It's a one bunch, same phrases. But the preferred and the non-controlling shareholders are the second set of. Okay, we also use the phrase hybrid shareholders because they are the people who are not fully shareholder. Maybe they are in the process of transition from debt to equity, and they are in between. Okay, so how we calculate the earnings per share? We have the final profit, but we also take away the profit which goes to the non-controlling shareholders or preferred shareholders. And then we divide by the number of shares in the, in the market. And that gives us the earnings per share. But believe me, in your income statement, the earnings per share is generally given. I've seen many of yours chosen companies' financial statements, and all I can say is that the earnings per share is 99 out of 100 cases is given. Okay, so this is called earnings per share. Once again, the earnings per share is one of those ratios which are super widely used by the shareholders to make a decision whether to buy the company stock or whether to sell the company stock they already own, or not, just to continue with the investment. Okay, so in the earnings per share are very important ratios to make a decision to leave the company, to join the company, and to stay or not to stay with the company. So that's very important. The earnings per share ratio. Any questions you have about this ratio? Have you seen EPS? EPS is a very common phrase we use in finance. Nobody says earnings per share in reality, but we always use this abbreviation called EPS. Have you heard this word, EPS? Have you? No? Nobody? Earnings per share. Would you like to invest in a company which gives you very high earnings per share or low earnings per share? High EPS or low EPS? Sorry, high, because that gives you more for the same investment. You have more profit. That's what you want, don't you? Don't pretend that you are a philanthropist. When you invest, you want to become rich. You want to earn more. Okay. So for given there is in the same industry, in the same sector, if you have the high EPS possibility, you go for it. The second investment ratio, which is very, very important, is called price to earnings ratio. Price to earnings ratio. And what is the price? Price is the share price, you know, the stock price. Where do you see the share price of the company? Where do you get it? Yes. Sorry? In the stock market. Have I ever shown you any databases where you can see some share prices from? Any name, any ideas? Sorry? Yahoo Finance. And what else? Do you remember? Investing.com is very good. And Morningstar is very good. So Yahoo Finance, this investing.com and Morningstar are the very useful resources which you can consult. I think most often I use Yahoo Finance. And then what is E? E stands for EPS. And what is EPS? EPS is point number 1, the earnings per share, price to earnings ratio. And price to earning ratio is a very important ratio that we use in making the investment decision. Let me give you an example. I think then it'll be clear. I share my screen. So price to earnings ratio. If the price to earning ratio of the firm which you are interested in is higher than the price to earnings ratio of the industry or the market, it means that you have been a very fortunate investor. Okay. So generally, the benchmark is that the price to earning ratio of the firm you invested in or your portfolio, if you have more than one investment, it must be more than the comparable price to earning ratio of industry. For example, if you invested in Microsoft, then you can take the price to earning ratio of Microsoft and compare with the industry, rest of the industry. Yeah. And that would give you an idea that if your investment proposition is a success or a failure. One more thing. We have two types of investors, even though we're a little bit going away from accounting and going to the field of finance, but it's a good thing because now after this lesson, starting from next week, I would drag you out from accounting and push you towards finance. But to learn finance, the precondition is accounting. And to learn accounting, the precondition is that you must know economics. So that's why we have this order of learning, okay? So there are two types of investors. Which investors? The stock market investors. The one investor, the first category of investor is called value-based investors. We use the phrase value-based investor. The value-based investors believe in a phrase. They believe in the phrase, and the phrase is the diamond in the rough. Diamond in the rough. Their job is to check out those companies which are marvelous. They have a great future. They have wonderful market share. The technology is state of the art. So the business will flourish in the time to come. But the problem is that maybe the company is unfortunate. Maybe the company's management is not so good. Maybe the company's decision making in the recent past has not been very, hasn't been so good. And as a result, the price to earning ratio of the company has fallen. The price to earning ratio is going down. But otherwise, company is not bad. You are not buying a company selling black and white TV. or you are not going to invest in a company which is deep, whose only business is coal mining, which would be finishing in the next few years. The company is innovative, company has all the possibilities to exist, all the reasons to exist. But because of some bad managerial decision or because of some other legal problems or something, the company has been in trouble, but this trouble would not last long. But of course, this trouble is affecting the company's present, but it will not affect the future. And because of all these multiple reasons, the price to earning ratio of this company is going down. Then, if you are a value-based investor, and you are having this drone looking for such companies, and you scan, okay, this, we have selected the 6 companies whose price to earning ratio is below what it should be. In other words, the company are treated badly by the market, but this discrimination would not last long. Eventually, these companies have all the capacity to bounce back, to come back. Then such companies are very good purchase for the value-based investor. Then if you are a value-based investor, you must go and buy these stocks without wasting time. The price to earning ratio, if below than a benchmark, then it's a very good bargain. Go and buy it, hold it, wait till the bad time is over, the price goes up, sell it, make money. Price to earning ratio is widely used by the analysts and the investors who are investing on their own. And one of the criteria when they are investing or selling or divesting is the price to earning ratio. And as I said, that the investors, the shareholders, they are not a homogeneous identity. Okay, there are 2 types, broadly speaking. The one is value-based investors. They always look for cheaper stock, cheaper, but not of the bad companies. As I said, they believe in this proverb called diamond in the rough. The company is a diamond, but it's in the rough times, the bad times. Okay, the second category of investors that we have is called, and they also use the they also use price to earning ratio, but differently. And we call these investors as growth-based investors. Growth-based investor. The first one were value-based. The second ones are growth-based investors. They believe that if a company's stock is expensive, and how do they know it? They compare the price to earning ratio of the firm. Let's call it firm stock. Firm means the one company which they're assessing. If it is more than the price to earning ratio of the industry, it basically means that the price of the company stock will become even more expensive in the future. So the price to earning ratio of the stock is more than the rest of the industry. Then, even though the stock is expensive, but they would still buy it. You know why they will buy it? Because it will become even more expensive in the future. What is the philosophy of the value-based investors? They want to buy cheaper so that they sell expensive. And what is the philosophy of the growth-based investors? They buy expensive and sell when it is even more expensive. Look at the philosophical difference between the two. The core idea of growth-based investors, that why should we buy cheap stock? Because it can become even cheaper tomorrow. What's the purpose? Buy more expensive so that when it's even more expensive, then sell it. I can give you several examples. When some companies' stocks are selling like hotcakes, they become so popular that if you go to some showroom, some mall, and if you don't have money and a share, you can pay the share and buy the things because nobody minds it. This has happened in the American malls when Microsoft was growing like, it was seeing a sea change, such an indefinite increase in the stock price. People were dying to buy Microsoft. I haven't seen any other company except Microsoft in the recent last 20 years, which people have been so obsessed with. I know then Apple came and then Tesla and all those very glamorous names, but nothing compared to Microsoft. Microsoft was a different animal altogether. People were dying to buy Microsoft. I mean, those who believe in Microsoft, they didn't believe anything else in the stock market. Okay, so this is a philosophical. So people who are actual investors, they make use of the price to earning ratio, but you can't calculate price to earning ratio if you know how to calculate the earnings per share. Remember, this E thing is basically EPS. So don't forget, this E thing is EPS, earnings per share. Make sense? Yeah? Yes or no? No?
Yes.
Yes. Good. Very good. Would you like to become value-based investors or growth-based investor? If you want to build up a portfolio, would you like to join the ranks of value-based or the growth-based investors? And why? Please give some ideas. Yep. You will become growth-based. Mm-hmm. Okay, so you want to become, remember, out of the two, value-based and the growth-based are more aggressive investors because they are going against the market. And the value-based investors are following the old-fashioned technology, not technology, but old-fashioned mindset, buy cheaper, sell expensive. Like if you own some, if you have some shop, you want to pay the lower and lower possible to the supplier, but you want to get more and more from the customer. This is their philosophy. Whose philosophy? Value-based. But the growth-based go opposite. They want to buy expensive raw material from the supplier so that they can sell it even more expensive to the customers. Because for them, expensive means rising price is a sign of company's future. When a company's share price goes up, it tells something about the company's future. And rising price means promising future. This is how they decode this information of rising prices. So they break this Da Vinci code by looking at the price to earnings ratio. Look, if you look at the price to earning ratio, you are calculating it in the present, but look at the numerator. What is the numerator? The price, stock price. It shows about the future. And what is the denominator? Earnings per share. It talks about the company's past. So when you are calculating this ratio, price to earning ratio, at present, you are incorporating the future and the past of the company. Why it's past? EPS, because you see it from the annual reports. And the annual reports are always written in historic sense. Now we're in 2022. The latest annual report you have is 2021, don't you? Nobody has 22 annual report. I bet you nobody can have it. And the stock price can change multiple times, thousands of times in a day. It can go up and down. I think I showed you from Yahoo Finance page a few times. So the price is futuristic. The earnings per share is historic. And the decision, you make it now. But look at the beauty. You are bringing 3 time dimensions in one measure. And again, you don't get the same message. You understand the message differently. If you are a value-based investor, you are getting the message differently in comparison to the growth-based investor. If the price to earning ratio of the company in question is more than the industry, the growth-based investor would say, buy it before it becomes even more expensive. And the value-based investor would say, hey, sell it before the price falls. So there is a big philosophical, kind of point of conflict or a point of deviation between the 2 categories of investors. So these 2 ratios are perhaps one of the most widely used ratios in the finance. Okay, so now we go beyond accounting. We can do the calculation in accounting, but their implications are more in the field of finance. Questions, comments? No? But do you understand this here? So if you are an investor, if you ever become investor, these 2 ratios you would never ignore. Any questions from my friends in Moodle? Something is in the chat. What is ACE? Did I say ACE? What is that? Sorry, can you be more clear?
Yeah, sorry. What I meant was, what is acceptable debt ratio? Like what?
Acceptable debt ratio. Yeah.
Yeah.
Very good point. Am I sharing my screen with you? Just a sec. I first share my screen and then I come back to this point. Just a second. Why the battery is not? Oh, because I didn't plug it. Sorry, very quickly going back to the debt ratio. Panu has asked very important question that you can calculate your debt to equity ratio, for example. Yeah. What should be the optimum debt to equity ratio? If you are a CFO of a company, for €1 of equity, what do you think? Where would you keep the debt amount? I mean, is it 0.6, 0.7, 0.9, 1, or more than 1? Where do you position yourself? You run the company and you are the CFO of a company. So where would you position the debt to equity ratio? Where you think that, hey, I'm living now dangerously. This is safe. So, or what factors would drive you to have the high or low? Is debt to equity ratio across the board? Is it homogeneous for all the companies, all the industries, all the sectors? I doubt no. So what parameter would you use to decide that, hey, my debt to equity ratio is safe and now I'm unsafe? Any ideas? You want to say something? Yep. 0.5, okay. What made you decide it's 0.5? Just imagine, your company is doing well, right? The interest rates are falling, very low, okay? You have good relationship with the banks. Your company is expanding. To have fresh equity issue, you have to go through the very lengthy legal process all over again. Debt, you can call the banker and make arrangement tomorrow. 0.6, 0.7, 0.8. It depends. It depends. That's my point. On what situation you decide that enough of debt, or in what situation you decide, no, I think we can have more debt. Why don't we have more debt? I want to hear from you. Feel free to give the ideas like this gentleman has given, that it depends on situation. First he said it's 0.5, then I slightly visualized situation, and then he said that actually it depends on the situation. But he's right, it depends on the situation. There is no one eternal debt to equity ratio that, hey, this is a lifelong debt to equity ratio. It doesn't work like that. It's a very dynamic concept, it keeps changing. But what factor you guys would consider? And feel free to say things. I mean, you don't have to give me very purely academic reply. Yep.
Also, like possibly say that possibly that maybe the lending company's policies that you guys possibly like influence how much debts they want to give out and how much debts possibly
That's true. Very good point. Debt you are tempted to get from the banks depending upon the bank's policy. There are two banks. The one bank is very conservative and very strict. Strong policy. You have to fill in so many formalities. You have to give them so many collateral to the bank, so many things that it's very mind-boggling thing for it. And then they're also charging very high interest from you. On the other hand, there's a bank which is very people's friendly. They are not the bureaucratic things are very not so big. All you need is to arrange a meeting with the bank and deposit your documents. And if all goes well, they will make a decision very quickly. They will not charge unnecessarily high rate of interest from you, very competitive rate of interest. The procedure is very simple and they really feel happy. They welcome you with a smile. So the bank's policies towards, and again, the bank's policy is not same towards every prospective borrower. Will it be? Anybody can go and knock the door of the bank and demand the loan from the bank, and the bank says, no, I don't want to give you loan, and you start fighting, say, no, look, my neighbor has got, come on, why can't I get? So what decide the bank? What makes the banks to decide, are you a good borrower or not a good borrower? What would bank check with you?
Have you any credit history?
Yes. Like same, that's a very good point. The second point, which the first point was that what is the bank's policy and how liberal the bank is. The second point, which you said is very valid, that what is your credit history? If you've been borrowing from the bank in the past and you have been repaying very well, so no complaints. Bank is very happy with you. No default, no delays. The bank considers you a high valued customer. Okay, and remember we have this rating called AAA, yeah, or A+++. This is ranking of the top companies, but even for the ordinary individuals and the small companies, small businesses, the bank has also this kind of mental rating. Hey, this guy been very nice last time, so in all the likelihood, he would be nice next time also. No, not to this guy. He has defaulted 3 times already. He didn't pay. Every time we gave him loan, he asked for extension of the repayment period. No to him. Okay, so your past record with the bank is a very important second factor after what is the bank's policy. Does bank really want to expand, be more liberal? And again, it's not a bank's policy, mind it. Remember, we studied a topic in economics called monetary policy. And monetary policy is about the supply of money. If the central bank wants to expand money supply, then it gives the decision, direction to the high street banks, Danske, Nordea, OP, to become more liberal in giving loans to the people. And if the monetary policy is very strict, then bank would be asked, told, ordered by the central bank of the country to be very strict. So it depends upon the monetary policy. The buck stops at the monetary policy of the state. And the second point, which you said is very valid, that how has you been dealing with the bank in the past? You've been nice in the past. You're a high valued customer. Not so nice. Sorry, thanks, but no thanks. What else matters? Yeah, if you are a company which has a very steady income, like even if you are an individual, and let's say you go to the bank and you want to have a mortgage because you want to buy a house, the bank would check, do you have enough income to pay back loan? And not only enough income, they would also check, do you have the consistent, regular income flow? Yeah. If you go to the bank and say, hey, and what's your income? You say, I'm a gambler. Okay. When I gamble successfully, I can even get 1 million euros. I can win a jackpot of 1 million euros. Can you give me loan? Believe me, they will not give you. Even though you are right, you might have won some jackpots in the past. Yeah. But if you go to the bank and you say that you work in a small organization, doesn't matter, but you have a permanent contract, you've been working, you've been consistently getting salary, it's fine. That's fine. So not only the amount of income, but also the regularity of the income is also very important. Okay, don't say that you're a gambler here. What else could be a factor in deciding if you're a good borrower or a bad borrower? Sorry? Yeah, I think that's a very good point, that it also depends upon how long, for how many years you have been asking, you're asking for a 20-year loan, right? The bank could be a little bit kind of shaky in giving you 20-year loan, that you never know, unless you're very young. Let's say you have just started your career, good career. You are in your late 20s or early 30s. The bank knows that this person would not retire in the next 35 years. So they would be more, kind of keen on giving. But if you are at my age and you go to the bank and ask for, can I take loan for 30 years? Believe me, they will not be very excited to give it. Yes, gentlemen there. Age, yeah, so we covered this point, yeah. So the age of this age is more valid for the individual borrowing, right? But not for the corporate borrowing. In fact, if you're an older company, the bank is more keen to give you loan, because that shows that, you see, the age of a company means you have braved many rough times. Only then you have been existing. Otherwise, you would have been bankrupt, isn't it? So the age of an institution is a credential of the financial and the business strength of the company. So company doesn't become weak and frail with age, unlike human beings, right? Okay, so that way, the same age factor can go against the individual borrower, but it will be a plus for the institutional borrowers. Very good point you raised. Any other point you think you can distinguish between good and bad borrower? It depends on when you borrowed. If you borrowed in the good times, the market is going up. Then the bank also know that this guy would be investing. The market in general is going up. Let's say if you are an investor in the early 90s, for example, the almost everywhere, every global economy, every country in the world was going up during early 90s. That was a very prosperous decade, at least half of the decade, right? 90s in general was very good for businesses. Yeah. So banks would be very keen to give you loan. But if you go to borrow from the bank, when there is a recession, when the war has broken out, when there are some serious geopolitical, environmental issues, social issues, or in general, there is a financial or business recession, why would bank lend you? And why would you borrow from the bank? Why would you invest when the whole market is down? That's the question. Anything else? Yeah, so there are different factors. So you're right. There's no one size fit all thing. It depends upon, and by the way, this is not only one figure, it depends upon different determinants, and these different determinants keep changing from time to time. So for example, 0.7, historically, hey, this is really good for me, but maybe next year it will be very unsafe for you. So you need to keep revising. And this is why the job of corporate finance manager is very difficult, because they keep deciding almost on daily basis, what is the safe limit of their debt? Are they too cautious, or are they too maverick? Are they too adventurous? So you have to live between overly cautious and overly maverick approach. It's quite complicated. More than numbers, it's the mindset. It depends upon the situation as well. So that's a very good point, Panu, you asked. I would have missed it. Some points of, I continue with it. The problem with the numbers is that they speak, but sometimes you can snub what they speak. And this is why the role of corporate governance is very important in finance, in accounting. The corporate governance is that as a researcher, as a student, as a corporate executive, you can't take the financial data as it is given. You have to take it with a pinch of salt. Otherwise, the companies can really do some cheating, not some cheating, but substantial cheating. And as a corporate governance researcher, which I have been, now Seher is also, you need to keep track what is the ultimate motive and what is the ultimate implication of this financial number. This is why when I say you this thing, that hey, not just calculation, interpretation, and what is the word? Inference you draw is very important, because that all deals with the corporate monitoring, control, and accountability. So you need, I'm putting this idea of governance in your mind, that is it so that one number can be interpreted only in one sense, or can it also be have different interpretations? I give an example. And remember one thing, the investors all over the world, whether value-based, growth-based, whoever they are, they take price to earning ratio very, very, very seriously. Very seriously. I'm yet to come across an investor who doesn't take into account EPS. Number two, EPS is used to calculate price to earning ratio, right? And what is the base? What is the denominator? Earnings per share. I want to give you an example. When a company is doing bad, but it is hiding the facts and try to cheat its investors, And this would become obvious in this tiny mini example. Imagine there is a company and it's doing very bad. The company is a sinking ship. The board of directors of the company know that. It's exactly like Enron company, which knew already that we are going to fall. They knew it. It was not a surprise. The company's board of directors knew 6 months ago at least that we are gonna sink for sure. Same example. A company knows for sure that it will not exist. They are in deep soup, not chicken soup, but some other soup. They will faint, they will die. Look what they're doing. They start asking the shareholders, look, try to understand the mindset. They are going to sink, but they not only want to hide this information from the shareholders, but also make believe shareholders that everything is fine, nothing is wrong. Rather, we are making progress. And what to do? They make a decision. You know what? In 6 months' time, we'll not even exist. Let's cheat the shareholders. Let's make an announcement that we are, hey, shareholders, we have lots of money and we want to buy shares back from you. What will happen? The shareholders would be very happy. At least one thing, they would believe that the company is not running short of cash. The company is resourceful. Before this thing happened, the company's cash was $40 million. But they are offering shareholders that, hey, for each share, we give you $15 and we want to buy 2 million shares from the public. It means that the company would pay $30 million to the shareholders. And then from 40 million, 30 million are spent to buy back shares. And now the company's cash balance is not 40 million, but 10 million. Do you know why it's 10 million? Because company has spent 30 million to buy back its shares. What next? Total assets. The company's assets were 100 million. The company's assets were 100 million in the beginning. And how much they have now? 70 million. Do you know why? Where is 30 million? Yeah, cash, because cash is a current asset. And company has spent 30 million to buy back shares. So the asset is now down by 30 million. Good job. The earnings, look, their actual performance was 4 million and their actual performance even now is 4 million. No change. This should have been more, but this is same. Share outstanding, they had 20 million shares in the beginning, and now they have how many? 18 million. There are 2 million shares because they bought them back. Okay, because they bought them back. ROA, return on assets. Can you calculate return on assets? How do you find return on assets? Can somebody guide me? What is the formula of return on assets? Yep. Earnings divided by the value of assets. So where is the earning? 4 million divided by assets. So when you divide 4 million by 100 million, it comes to be 4%, right? And now see, the earning is still same, 4 million, 4 million. And this time you divide by 70 million. And when you divide 4 million by 70 million, your return on assets goes up to 5.71. Look, the company is in a state of retardation. The company's profit is same, actually, as before. Nothing has changed. But look at the return on assets from 4% to 5.71%. And when you publish this data in Financial Times, in Yahoo Finance, that hey, companies' return on assets jump from 4% to 5.71%, people would believe that your company is the best. Look, so fast, your ROA has jumped so significantly. But the fact of the matter is that you are actually not increasing the numerator, but you are decreasing the denominator. The two ways a number can be more than before, either for the same denominator, the numerator is improving, or for the same numerator, the denominator is going down. And what you have done, you were calculating ROA by dividing this number with this number. But now you are calculating ROA by dividing this number with this number. So you have less assets than before. The assets determine company's existence. You have sold your assets. And when you are calculating ROA, it jumps from 4 to 5.71% because this is how the ratios are calculated. And you are basically emitting a very positive sign about your company. But the fact of the matter is that it's not increasing because of your good performance, but because you are selling your assets. And same way, you can calculate the earnings per share. You divide your earning by number of shares. Where are the number of shares? 20 million. Your earning per share is 20 cents per share. And what happens now? You're dividing the same amount of earnings, but by lesser number of shares. And look, your EPS has gone up. If you are a superficial investor, if you don't dig deep, if you have no background of accounting and finance, if you don't take the information with a pinch of salt and you believe with the folded hands and the blinded eyes, whatever the company is saying, then believe me, you will lose your money. Even though on the face value, the ROA is very rising, the EPS is rising, you know what? Your company would be kind of talk of the town in the financial market. Hey, the EPS jumped from 20 cents to 22, 10% increase in the EPS. Goodness gracious me. But if you don't have this basic knowledge of finance, then the company is cheating you. So this is why this phrase I use very often, that take the company's claims with a pinch of salt. If you see the claim, try to be a little bit more innovative, more initiator, and do some calculation by yourself. You would be in a better position to get the real image. Okay, so the manager can do it too. And believe me, this happens in every system. There's no system where these manipulations are not done. In some systems, they're done more with more audacity without any legal fear. In some systems, it's done in a below the radar, but in every system, it's done. It's being done. Okay, the magnitude can vary, but the instinct are the same in every system. Okay, so and then I gave some ideas here that which factors can push your financial ratios up and down. Macroeconomic situation is very bad, is one reason. You know, as we all know that the things in Russia are not going well at the moment. If you are a company based in Russia and you have borrowed from some foreign bank and you need to pay them in dollars or in euros, and you have to pay lots of money now. And it could be possible that your debt covenants are broken. So, and with the result, things can go really, bad. So you know that some macroeconomic factors, inflation, interest rate, exchange rate fluctuations can have a lot of impact on your financial performance. And so it will affect on the ratios as well. You agree with me? A student of mine, she's from Russia. A few days ago, she was asking me that what is the Russia's economic solution at the moment? And I said that there is an economic problem, but the solution is not economic. The solution is more political than economic. So this is how things happen. That sometimes we have the problem of different nature, but the solution is of different nature. So this is how we go about. What do you think? If you are told to handle this crisis from the economic point of view, what would you do? And I want to ask this question to everybody. What would you do to solve this problem? At least mitigate the problem, if not fully solve it. Yeah.
Actually, the people who work in Russian central bank are quite competitive people. Yeah, they have reason. The interest rate, central bank, and they have issued some laws, and they actually mitigating this crisis, but the consequences of this crisis.
The scale of crisis is very big. Yeah, yeah. So, yes.
The GDP of the country will be falling.
Okay, very good.
And yeah, that's a problem, but they are trying to mitigate it.
Yeah.
And I hope they will be able to do that at least at some point.
Okay. Anybody from this? Yes, sir. I'll come back to you later.
Also, kind of problem that the Russian stock market is still closed.
It's closed.
They don't even know the whole scale of the problem.
Yes, yeah, yeah.
Nobody can tell.
Nobody tells because the stock market is closed.
Yeah, that's Russian stock.
Yes, yeah, yeah. That's true. And that's a very good point that you don't even know the real scale yet, because once the stock market opens, if it opens in the near future, and then we have to see. Yes.
Russian central bank is not able to help Russian banks in a long-term period because all reserves are frozen. Gold currency reserves are frozen, and it's kind of they're going to be a default, the financial default in Russia. Soon. And the interest rate is more than 20% nowadays.
Yeah.
So the right that the solution is political. So the one action that everyone should do is stop this political action.
Yes.
Yeah. That's the best decision.
That's the best. That could be the best decision, that we leave our egos and we become better human beings, and we try to live happily. As at least we can make an effort to live happily. Yes, sir.
The default is not that scary because this is a technical default, because about the half of Russian central bank assets are frozen, just frozen in euro. So Russian doesn't have currency to pay its debt. So that's the technical default, and that's bad. That would harm Russian reputation if it exists. Yeah, but that's not a great problem for Russia, actually, because the default arise from the default which happened in Russia, for example, in 1998. Because at that time it was extreme collapse, and now it's just a problem for reputation. But no, Russia has a great and well diversified. Yes,